All right, so um, nice having you here today, Randy. Thank you so much. We all know that a vital part of home buying is getting your credit straight or getting, having the required credits. In most cases, especially if you need down payment help and all of the awesome programs that can help you pay as little as possible out of pocket to get your home. You need to have at least 640, especially in the state of Georgia. So getting your credit to a point where you can take advantage of this program is very important. And that's why we have Randy here, who is an expert in this area today to give us some tips and explain what NCC can do to help you get there and get your dream of home ownership. And so I'm going to hand over to Randy now to give us some of those nuggets and give us what NCC can do. And then when we're done with that, I'll wrap it with a special offer that NCC has got for my client to make the service and process easy and affordable. So we're going to go over that once Randy is done with the program. We're going to close out with that. And so with that, I'm handing it over to you, Randy.
Perfect. Well, thank you. Good morning. I appreciate you having me on. Excuse me, my voice went right at that time. I wanted to start off by introducing myself a little bit. So here on the slide, you can see I'm a Senior Regional Director for National Credit Care. Been here for 5 years now. I run basically the Eastern Seaboard. So from New York all the way down to Georgia, that's my territory. And I usually, during the normal world, I travel for a living. So, I travel to all of these states, educating both loan officers and realtors on the FICO education pieces, as well as teaching and educating on credit scoring and how we can increase scores. So, I really like to get to the root of why we exist. And what I mean by that is my business. So about 15 years ago, when we became a company, there was a Federal Trade Commission report done on credit reports, and this should just blow your mind, but they determined 80% of all credit reports have detrimental errors on them. Now, these errors are causing people's scores to be significantly lowered, and that's just not a fair slice, especially when you're trying to apply for a home loan. You're here trying to get that dream home and that dream of home ownership, and you're being dragged down by a system that has this many errors. I mean, it equated to 40 million errors on credit reports. Now, that was 15 years ago. I can tell you it's not gotten any better. That's why I'm here, and that's what I do, is to help correct those errors. So the Federal Trade Commission came out with a government act called the Fair Credit Reporting Act. Now, this act is extremely powerful for you as a consumer because it states that every item on your credit report now has to be 100% complete, accurate, and verifiable by law. So I essentially will look into these investigation items for you in order to remove the erroneous information off of your credit report, thereby boosting your score. And I'll explain a little further how I do that. But I do want to tell you, historically, for these 15 years, we've averaged right around a 20-point increase and 4 deletions every single month off of our clients' credit reports. So pretty big increases and jumps, and 20 points can be the difference between a home or not a home when it comes to this market right now. So it's extremely important to really look into your credit. With that said, I want to kind of go over how scores are formed. So this is something that's not educated or taught anywhere. I went to at Duke University, a pretty prestigious school. I got a great degree in electrical engineering. I took some finance classes, but I was never taught anything about credit. And I've noticed in my time of doing this, no one is. So, it's an unfair system if you don't know how to manipulate it. And that's what I do for your clients. First and foremost, there's 3 credit bureaus. I think everybody understands that. There's Equifax, there's Experian, and there's TransUnion. Now, I know them by their birth name, as I like to joke, but I know them as Fair Isaac version 2, Classic 04, and Beacon 5.0. And the reason I call them that is that's the actual algorithms that are used to calculate scoring. They're each a little individual and they're each a little different. However, those are the pieces of the pie that really make up your credit score. So it's really important to understand the reason there's 3 bureaus out there is because in the world, there's 54 FICO algorithms. So if you're looking at things like Credit Karma, that is a FICO algorithm. However, that's not an algorithm used for lending. So that's just a soft look at your credit, a way to assess things and a good monitoring tool, but the scoring can be very different on Credit Karma than it can be on your actual mortgage score. And the reason there's a difference in scores, even between the 3, is really simple. There's minor deviations in the math, but then there's also this thing called contracts. So I like to educate my clients on understanding one thing and one thing only about this. The credit bureaus themselves, they are an at-profit business, right? They're not government. They're kind of government regulated, but they're in a business to make a profit. And their profit is made by contracts. So every creditor out there that wants to report to the credit bureaus can choose. So this could be Bank of America, for example. They choose to report to all 3 bureaus. And to do that, they pay each bureau every time they report a piece of information. But there's lots of creditors out there and collection agencies that only report to 1, or maybe they report to 2. There's no legal requirement for a bank or a creditor to report to the bureau. They choose to do this through their contracts with those credit bureaus. So that's why you'll see deviations between the scoring sometimes, because you may not have the same items on all 3 credit bureaus. That's why in the mortgage industry, we use what's called the middle score. We throw out your highest score, we throw out your lowest score, and we use that middle FICO score. And that's the best way to assess risk as a loan, to make sure that your credit is worthy enough to take out a couple $100,000 home loan. There are 5 industries that use credit as risk analysis. I'll just tell you what the 5 are. It's the mortgage industry, the auto industry, the revolving industry, which is going to be credit cards. And this is very important. I'll discuss a lot about credit cards here on the next slide. There's also the insurance industry. Yes, your car insurance is regulated by your credit score, not just your driving record. And then finally, there's the online or other industry, and that's going to be things like Credit Karma, Credit Sesame, True Credit. I mean, there's a million of them out there, and those are for your consumer looks at your own credit, and that's why those services are free. All right, so now that we know that, let's talk about what's actually in the FICO algorithm. So, excuse me, if I were to take all 3 of those algorithms that I mentioned earlier and put them into a pie chart, kind of crunching them down into what goes into your credit score, this is what it essentially would look like. So first and foremost is payment history. This is 35% of your score. It's the biggest piece of the FICO algorithm. Now this is where everything good, bad, and ugly lies. This is going to be all your positive payment history as well as your negative payment history. It's also going to be things like bankruptcy or repossession or foreclosure. All of that is rolled up into just 35% of your score. So feasibly, you could never pay your bills on time and possibly somehow still have an okay credit score, because there is 65% of these other pieces that are very important in the algorithm. Now, working with somebody like myself, I've learned to manipulate 90% of this algorithm. There's a 10% piece I just can't do, but 90% of the algorithm can be manipulated in order to boost your credit score. So moving on from payment history, we move into debt utilization. Now this is only credit cards, and this is why I want to really break this piece down. So credit card utilization is 30% of your credit score. That's almost a third of your entire score is rolled up in. If you have 1 card, that 1 card. If you have 3, those 3 cards. But where you get the points and where you get the utilization from is actually, where you get the points from is actually the utilization of the card. So perfect credit card utilization to maximize your points is 10% of the available balance. So let me give you an example. If you have 1 credit card and that's all you have, that whole card costs 30% of your credit score. Now let's say it's a $1,000 limit credit card. That would mean to maximize all 30% of those points, you would want to be at $100 charged on that card or less every month. The second you start going above $100, you start losing points. So when it reports to the credit bureau that maybe you're at 500 of your 1,000 limit, that 50% utilization actually takes away pieces of your credit score that can significantly affect your overall scoring for that month. Now, the good news is with utilization, it can be manipulated very quickly. If you pay that card down or off, you would then get those points back on the next credit report cycle the following month. So this is a really important piece. And what I'll do for the clients that I work with, I'm going to analyze your utilization. So I'm going to give you an action plan. Most people, if they have one card, they have many cards. The good news is they're individually weighted. If you have 3 credit cards, that would mean they're each worth 10% of that 30. If you have 5 cards, they're each worth 6% of that 30. So it doesn't matter if one's a $10,000 limit and one's a $500 limit, they're equally weighted on your credit report. So my first step in this area would be to maximize your utilization, starting with the lowest balance card first, paying that down or off and working our way up to a bigger card, because that's going to generate more credit score increase than anything else. Now you probably ask, well, what if I don't have a credit card? Well, that's the most important thing you can do to influence your credit. And if your score is too low to qualify for a traditional credit card, there's a program out there called secured cards. Now, almost every bank in the country offers them. I usually work with a bank called Open Sky. I like the way that they work. But essentially, you would open up a savings account. Open Sky requires a $200 deposit. You'll open up that Open Sky deposit account, and now you'll have a $200 credit limit. It reports exactly like a credit card on your credit bureau. It doesn't look any different than if you had just got a new Capital One card. It's the exact same thing. But now that you have this good credit limit and a revolving account with $200, you want to maximize it by putting no more than $20 a month on it and then paying it off on time. So this is the education I will provide to each and every client, especially in this area, because it's so big and so important. All right, moving on. So let's talk about the next piece. You can see their length of credit history. This is 15% of your overall score. Now, your ultimate goal in length is to have 25 years of history. However, it's an average of all of your open accounts. So somebody like me, I love cars. I buy cars every couple years. I always will struggle in this area, and here's why. I could have a 25-year-old credit card that has 25 years of history, and that's great. But when I buy that next car, it adds a brand new account to there. So now that's going to give me 25 years for the card, 1 year for the new car, and then they're going to take out the average of that. So that'd be 26 divided by the 2 accounts. That would be 13 years. So every decision you make when you open credit affects this piece of your score, and it's a very large piece at 15%. Now, the good news is this can be manipulated as well. What I'll do for my clients is things like I'll add them as authorized users to maybe their parents' credit card, which would establish very long length. I may have them take a student loan out of deferment and make one payment on it, because they would then inherit and activate all the length from that old student loan, many times going back 6 to 7 years. And all of a sudden you have this big jump in your credit score because you inherit that length. So there's lots of ways to manipulate here. This is also the piece of the pie where you'll always hear people say never close a credit card. Yes, I would 99% of the time agree with you. That is a bad thing to do. However, there are instances where closing a card could potentially boost your score. And as an expert in the field, I may educate a client to do that if I know it will benefit them in the long run of length in boosting their scoring. All right, next piece of the pie, 10% new credit. This is the only part of the algorithm where you start with all of your points and you can only lose them. Now, the reason you lose them is twofold. You're going to lose them for what are called hard inquiries. So every time a bank or a lender or a car company or a credit card pulls your credit, you're going to lose 2 to 6 points off of your credit score for that hard inquiry. There is no shopping windows, just to clear this all up. If you do pull your credit multiple times, no matter how many people tell you there's a window, I can promise you there's not. You will see a dip in your credit score the following month, and it's going to be for those inquiries. Now, the other reason you're going to lose points is by opening a new account. So when you open any new account on your credit report at all, whether it be a credit card, a car, a mortgage, you're going to see a large dip in this piece of your algorithm. And the reason banks do this is they want to stop somebody from going out. Like if I were to go get a new Discover card today, they want to see how I use that new credit. So they're going to try to deplete my points so I can't go out and get another American Express card at the same time. And if they do that by depleting me, they're going to see how I then operate that credit. That's why it happens. Now, the good news in this area is A, working with somebody like myself, I remove the hard inquiries. And B, the other side of this is the longer you have since you opened an account, you get these points back. So around 90 days, you'll start to see some of them come back in. And around 6 months, you'll see most of, not the rest of them come through. So it's a really easy process, but you will take a dip by opening new credit at any one time. All right, final piece, and this is why I say I can manipulate 90% of the algorithm. This is the one section I cannot influence, but I want you to understand what they are. To have perfect 850 credit, not only do you have to have perfect payment history, perfect credit card utilization, 25 years average length of history, no new open accounts or inquiries in the last year, you have to have this last piece. So 10% is called types of credit used. This is where you hear people often refer to it as mix of credit. A perfect mix of credit is one of 5 types at a minimum. So you have to have a mortgage, you have to have an auto loan, you have to have a revolving account or a credit card, you have to have an installment loan of a different type, meaning not an auto loan, but maybe a signature loan or a home equity line of credit, something that's an additional installment loan. And then you have to have an other. Now, other most traditionally is going to be your green American Express charge card. Those are not credit cards. If you qualify for an American Express charge card, that means I could put $10,000 on it this month, and at the end of the month, I owe $10,000. There is no minimum payment. It is not a credit card. It just allows you to charge things for the month and then pay them in full at the end of the month. So to have perfect mix, you have to have one of every one of those types of accounts. You'll also see this is probably why I've never seen an 850 credit score. It's next to impossible. Great credit starts at around 720. So anything above 720 and up, you're in the great credit realm. And I have seen many 800s, but the difference between a 780 and an 800 is pretty negligible at that point. You just really want to go into that 720 and up range. That's your goal. All right, moving on. So now that I've kind of educated you on what's on your credit report, this is a list of what I can remove from it. Now, my service under that Fair Credit Reporting Act, my ultimate goal is to remove negative and derogatory accounts and items off of the client's credit report. So you can see it's a pretty big list, but I usually like to break it down on what's easy to remove and what's hard to remove. So first, easy. Any kind of medical collection. I will remove that in my sleep. That's the easiest thing I can go after. Followed closely by $0 collection. So a collection that maybe you've paid. And this is an important note that I really try to get across to everybody out there. Paying a collection does not remove it from your credit. In fact, most times it hurts your credit, and here's why. The amount of the collection doesn't matter. It could be $17,000 or it could be $0. What matters in the collection is what's called the date of last activity. So if you have a 8-month-old collection for $1,000 and you want to say, I'm going to work on my credit, I'm going to pay off that $1,000 collection, all you've essentially done is refreshed it as brand new because they don't delete it. They remove the amount, they make it $0, and they refresh it to a brand new last activity date because you just made it active again. So it's really critical that, especially realtors on the front line, they educate their clients on this because most people I hear say, I'm going to work on my credit. They do things that actually hurt their credit. It's really a sad situation, and it goes back to that education piece where people just don't understand the algorithms. They don't know what happens, and logic would dictate if I pay something off, I should get better credit. In these cases, that's not how it works. So if that's happened, if it's already been paid off, the good news is it makes my job easier. They don't fight me very hard when there's no money involved. So medical $0 collections, very simple to remove. After that, we get into traditional collections. So this will be things like utility bills, cable bills, cell phone bills, apartment complex move-out bills. I mean, I've seen it all. At this point, my goal is to remove these collections without the client paying a dime. We just are going to beat them at the game of fair credit reporting. Then you get into the harder things. So this will be charged off credit cards, repossessions, foreclosures, and bankruptcies. Yes, I remove them all the time. They do, however, take a lot more work, and the work is going to be explained on this next slide right here. So I'm going to tell you exactly how I do this. It probably sounds like magic. I promise you it's not. We're just really good at a process, and this process is really simple. First and foremost, when I look at a client's credit file, we're going to look for detrimental errors. So this is just going to be straight up errors. Some examples would be I had a client recently that their mortgage was transferred to another lender. So it went from Ditech to Bank of America. On the Ditech mortgage, on TransUnion, it said paid closed. On Equifax, it said paid closed. And on Experian, it said foreclosure. It wasn't a foreclosure. There was just a flat out error on a credit report, and it was a very simple process to fix. This will also be things where there's missing information. If there's no date of last activity, if there's anything that says unknown, that's illegal. That cannot be on your credit report. So that's the first step of what we're going to look at is those surface errors. Then we're going to move on to non-verifiable. So I'm going to launch these investigations within 24 hours of getting set up with an account with me. Those investigations are going to require very specific answers. Those answers are going to be things like original signatures on your documents or payment records from the company, cleared check information. I can ask for anything to verify that debt, and they are legally required to respond within 30 days to get it back to me. If they cannot verify what I have asked them for, then it is not allowed to be on your credit report and it will be removed. After that, we push this timeline. I mentioned 30 days a lot throughout this presentation. Fair Credit says they have 30 days to respond. How can I make that harder for them? Well, the easiest way is I use the mail. We don't do anything electronic. Everything I do is through the US mail. My firm sends out 10,000 investigation letters a day, 5 days a week. That's 50,000 letters a week that go to the credit bureaus on my client's behalf. When those when those letters are received at the bureau, that starts a 30-day clock. The beauty of the system is if I start the investigation in the mail, it has to finish in the mail. So when the credit bureau gets the letters, they then send that letter off to the original creditor. The creditor has to dig up whatever we have asked for, send that letter back to the credit bureau. If they cannot or do not provide an answer on day 30, then on day 31, regardless of if it was accurate or not, it is removed off of your credit right there at the bureau level. So that's another piece of why we're successful. And then the last one's probably my favorite. 15 years of doing this, the creditors know our name. They know who we are. In fact, the ex-head of Equifax was in our office recently, and he told us that just at Equifax alone, they had to hire 79 new employees just to handle the amount of investigations we launch on a monthly basis. So I've created 79 new jobs by investigating just the errors on people's credit report. But what it really boils down to with every account type, I don't care if it's a repossession for $56,000 or a collection for $100, there's an economic decision that has to be made by the company. They know I'm not ever going to stop while your clients are working with me, and therefore every month they're going to receive these letters. They're going to have to dig up more information. They're going to have to send Susie from accounting down to the basement instead of doing her job to find records for my clients. There's a point where it's not worth their money anymore to fight us. They're going to just give up and make that decision that it's not worth their time and energy, and that's when I'll win on some of these bigger ticket items. So that's really the how behind the magic, okay? All right, final slide is cost. I'm gonna save that one though, because Eunice has some specials for you. This is my contact information, so please take a screenshot of this. Anybody that needs some help, obviously going through Eunice, she'll get you to me. But if you have friends or family members or anybody else out there that's maybe not in the home purchasing process, I can still help them. Please just make sure that you get them over to me so I can be of service.
Thanks, Randy. Thank you so much.
You're welcome.
So I am going to, like Randy said, when my mission is to get you into your home, no matter where you are right now, your credit's not good, you don't have money for down payment, you need to be talking to me because I may just have the right solution for you. And that's my job, to look for the right program and work with you wherever you are right now in the process to take you to where you need to be, where you can take advantage of whatever your desire is. You want down payment help, you want closing cost help, you don't have any money out of your pocket, you just want to, all you have is your monthly mortgage payments. Talk to me. We will work something out for you. We'll come up with strategies that can help you and get you into that home. And that's why I've partnered with NCC. And what you'll get is your initial payment to get into the program would normally be $189. But as my client, you're going to get $100 off of that. And so your starting payment will be $89 and subsequently it will be $79. I don't know anywhere else where they do awesome job like NCC where you will get this kind of bargain. So you want to start talking, calling right now. Let's come up with a strategy for getting you into that home. Let's do it, work with NCC if you need credit repair. And also on top of that is at closing, when you work with me, I do give up to $350 credit towards whatever you spend on credit repair. So when you work with me, most of the time you will mostly cover most of your spending or whatever out of pocket that you spent on credit repair. You'll get them back at closing because my intention is to get you into that home, work with you to get into it. There's no reason why everybody in this country can't be a homeowner, and that's the truth. That's the fact. There are programs, there are things, there are teams that are working day and night to make this possible, and that is what I have committed to. That's what I'm passionate about, and I will get this done for you through my partners like NCC. I have lenders that are working day and night to make that happen. I even have lenders that will match my $350 credit for you at closing if you spend more than that for credit repair. So we win this to win it together. We want you to win this together. While I'm going to have my information up here, I'm going to be asking Randy some of, because I know you will have questions, and so I'm going to have those questions answered by him right now. And the first is, so you said if your credit is, if people's credit gets pulled, you lose some points from whatever your credit score is. So are you going to be making any kind of hard pull on people's credit that might actually negatively impact or be counter productive to what we're trying to achieve here?
Sure, great question. No, I'm the only firm in the country through my licensing with the credit bureau that is allowed to do a master copy soft pull. So the difference between a soft pull and a hard pull is a hard pull will take away the points and actually is used for the purpose of loaning money. That'll be a mortgage pull, a credit card pull, a car pull. What I'm going to be doing is a soft pull, similar to if you were going to check your own credit on like a Credit Karma or a Credit Sesame. The difference though between that and what I do is I'm getting a master copy from all three credit bureaus, and that master copy will be the deepest dive into your credit that you've ever had pulled, but without any negative impact on your credit score.
Awesome. Thanks, Randy. So also, you talk about being able to remove a lot of this negative remarks and collections and the likes. What do you think after they remove it? Let's say they're not able to respond in 30 days and then they eventually respond. Do you think those items can go back to my credit and then be a negative part of what we're trying to achieve?
Another really good question. So in the process that we'll be working with a client, I'll say no. However, there is about 15% of the time with certain collections that they do end up showing back up. And here's the why though. I say 15% because the credit bureau is getting good at this. Once you have lost an FCRA investigation, it cannot be put back on your credit no matter what. 15% of the time right now, the credit bureau doesn't catch if the creditor sells it to another agency. So let's just use a case of I beat portfolio recovery. It's removed off of your client's credit, and then 6 or 7 months later, they're in their home, everything's great, and suddenly they get a collection for the same account, but from ABC Recovery Service. Well, what they've done is portfolio has sold it illegally, and they've sold it to ABC, and ABC has hung it back on there. Now, 85% of the time, the credit bureau catches these and says, sorry, you've lost an FCRA investigation, you cannot put this back on credit. That 15% of the time it may sneak through, those clients can call me. I will send out an emergency round of investigations with no initiation fee to get it removed because it's a very simple process because they violated the law.
Okay, awesome. Thank you.
Sure.
Also, what's the average time frame for getting credit repair on the average from when you've seen most people starting from the
Sure.
possible lowest to about, for me, my target is always to get my clients down payment help, and that will be, I want them to be sitting comfortably at like 680.
Mhm.
What's the average timeline to achieve that? Like, for example, if for people that are still interested in buying their home in 2020, do you think that's achievable, and what should they expect?
Sure. So my average client historically is 3 to 5 months. But think of it this way. Right now, we're not dealing with the normal world. We're dealing with people right now that may have 620 scores that can't get a home loan. And that's never really happened before. They used to go down to 580, even lower in some places. So people with 620s are not going to take 3 to 5 months. I can usually knock those out within 60 days. But if you're sending me somebody that's maybe in the low 500s or mid 500s, that's more going to be a realistic case of 3 to 5 months. Really, it goes back to the average though. 15 years straight, we have got 20 points per month of average deletion and increase for 15 years. Right now, it's a little bit higher. I'm hoping this continues, obviously, for a few more months. However, if it doesn't, the good news is I'm always going to get you around that 20 points per month, and then you can kind of determine how long it's going to be. If you're a 600 and you need a 680, well, we'll say probably about 4 months. If you're a 580 and you need a 640, well, you're looking at 60 points. We're looking at probably around 3 months, and that's really the way to break it down.
Cool. Awesome. That sounds exciting. I actually do have a lender that will still do 580
Mhm.
FHA right now, but you do have to have your 3.5%. So,
Right. Yeah. They may not like the terms. That's the problem. So if we can get them
right.
from 580 to 640 though, and it's a much better deal for them, then obviously that would be something we could work out too.
Yeah, that's true. I always tell people try to get down payment help if possible, and that will be
Right.
around, you want to be, you can get it for 640, but you want to be sitting at 680, to be sure that you're getting the best interest rates. We haven't even
Right.
talked about that, apart from getting some help in out of pocket costs. Your whatever you're going to be paying monthly is going to also be influenced by what your credit score is. So this is
Absolutely.
definitely a vital part of home ownership. It's a vital part of anyone's finances for sure, because you want to buy a car. A lot of things, are driven by what your credit score is. You can save a lot of money if you have, good credit score. And then also, another thing that I want to point out about NCCA is they don't only um, just fix your credit and then you go away and then things come back to where it was. They actually do work with you to the point where you understand what's going on, so you can actually be empowered to continue in that positive light. So it doesn't end when your credit is key. If it's fixed for buying this home, it also, it will prepare you for what you need to do moving forward to keep this positivity going, right?
Absolutely. Yeah. Education is a big piece of this. And you brought up some good points. Your credit is literally the best investment you can make financially over anything. I would argue it's better than investing in Bitcoin at the very beginning, platinum, you name it. If you invested the same amount of time and energy and a little bit of money helping, fix your credit with me, the return is greater than anything out there. Because I guess a lot of people don't understand, but let me just give you a jaw-dropping example. A 620 to 640 credit score on average in the country right now pays $1,300 more per year per car for their car insurance over someone in the 700s. And that's in the 600s. Don't even get me started what it is in the 500s. But every 6 months, your car insurance pulls your credit and determines your bill based not just on your driving record, but excessively on your credit score. So it's a very significant drain of your funds to even be in the 600s. You're basically having your money stolen from you every month And people have become so used to it, they just don't understand. They go buy a car and they think they got a good interest rate at 9%. That's not a good interest rate. If I go to buy a car today, I will pay 2.9 or less guaranteed, or I would never even take the deal. I mean, it's an amazing difference once you understand how much you're stolen from. And once you start with average or bad credit and you get to the point that you're no longer there, you will do and know whatever it takes to not go back to that point.
Right, awesome. So I think that's it. Thank you so much, Randy, for spending this time.
Absolutely.
And everyone, call, send text messages, email. You see my detail up there. Let us get you that dream. This 2020, let the dream come true. You can do it. Don't let anyone tell you you can't. Don't let anyone tell you what you need. I will work with you to figure it out. We will figure it out as a team. I have teams. NCC is one of my team. I have lenders that are committed to this mission, getting people into their own homes, because it's a vital part of human life. It's one of the biggest American dream. Let's get it. Let's make it happen. Just reach out, call, text, tell your friends, tell your family that it doesn't matter where they are right now. We will work with them, holding their hands as teams to get them to the finish line and make that dream come true. Do you have anything, last minute thing to?
I don't. I just appreciate the time and look forward to continuing to help people with you like we started doing here today. And again, if there's any credit related questions, anything you guys need, please feel free to reach out anytime. My phone number that was on there can take text messages as well.
Yes.
So please feel free to reach out.
Let me stop this so you can stop the sharing so you can share that one more time.
Oh yeah, give me 1 sec. I actually closed it. Give me 1 second.
Okay.
Go figure. Now I would need something else. Oh, it still had you sharing. That's okay. I'll just give you my number. It's easier. If I need any direct contact from me, call or text. My phone number is 303-325-5492.
All right. Thanks, Randy. We're really grateful for your time.
All right. Thank you so much, Eunice. We'll talk to you soon, okay?
Talk to you soon. Thank you.
All right. Bye-bye.
Bye-bye.